For more on the economy, we're joined from St. Petersburg, Florida, by Scott Brown, chief economist for Raymond James. He's ranked one of the most accurate economic forecasters by Bloomberg, making him a Bloomberg best. Scott, welcome back to Bottom Line. Always a pleasure to have you on.
Nice to be with you, Mark.
Scott, according to the numbers, the macro analysis and the statistics, the recession officially ended in the summer of 2009. But we have new research out by two former Census Bureau officials. They say that household income declined more in the 2 years after the recession ended than it did during the recession itself. The income drop between June of 2009 and this June was 6.7%. Why do Americans' incomes keep falling? Is it time for a new definition of recession?
Well, we like to say this isn't your father's recession. This is really your grandfather's depression. We went through a major financial crisis. This isn't your typical recession where the Fed raises rates because they're worried about inflation. You have pent-up demand build up, then the Fed lowers rates and the pent-up demand comes roaring back in. It's not going to happen this time. It takes a long time to repair the financial damage for households and businesses to repair their balance sheets. That progress is well underway, but it's a very lengthy process. We saw the job market weakening substantially during the early part of the financial crisis. The job market has turned. We are adding jobs. It's just not especially strong at this point. It's more like we're just running in place.
Scott, how has this income decline affected American standard of living?
Well, I think for the typical household, the belts have been tightened. During the boom period, we had increases in oil prices, but the consumers didn't pull back, and that's largely because they were using their homes as ATMs. They took out a significant amount of equity from their homes and used that to finance the consumer spending. That's all gone away. In fact, consumers are continuing to pay down mortgage debt. So that leaves them with less money to spend on other things. This year, we started to see some good news. We had pretty good job growth in the first 4 months of the year. Private sector payrolls were rising on the average over 200,000 per month. We had a cut in payroll taxes, which put more cash in consumers' paychecks. Unfortunately, gasoline went from $3 a gallon to $4 a gallon, and that really hammered the purchasing power. Gasoline prices have come down. But they still have more room to come down, and it's a little bit of relief, but I think it's probably going to be more helpful as you head into 2012.
Scott, you were just talking about jobs. If we are technically in recovery mode, why has unemployment been stuck at 9% or higher for the past 2 years, and why are record numbers of Americans now living below the poverty line?
Well, it's almost been a tale of two recoveries. The corporations have done pretty well. Corporate profits are at a record high. That doesn't mean that they're going to go out and hire people. In fact, one of the reasons that profits are so high is that the firms have held the line on controlling labor costs. We normally look to small firms, medium-sized firms, startups to really account for a lot of the job growth in an expansion. And those small firms are still credit constrained to some extent, but they're also not seeing an increase in demand for the goods and services that they produce. So, it's a bit of a chicken and egg kind of question still. If we get a bit better demand, firms are going to go out and hire people, and that will in turn add to consumer demand and so on. Yeah. I think gasoline really worked against that cycle in the first half of the year. We still have a lot of headwinds. We still have the housing sector that's still undergoing a lot of problems. Sure. We have state and local government which is contracting. But I think we are progressing, and there's a lot of questions we have about 2012, but this recovery, again, is going to take a long time.
Well, the National Bureau of Economic Research notes that in the early stages of an expansion, economic activity is typically below normal and could remain so, according to the Bureau, well into the expansion. Is that what we're seeing right now?
Well, I think we've seen a change in sort of the recoveries. If you look at the two previous recoveries that we had, the 92 recession and the 2001 recession, it took a long time before the job market really got going. So this is kind of fitting into that more recent pattern. If you go back to the recessions of the 70s and 80s, they were more V-shaped because, again, you had a lot of pent-up demand in housing and autos. And that's certainly not going to be the case this time. So I think we are, again, looking at a very gradual process.
Scott, there was an article in the Washington Post. Economist Carmen Reinhart noted that during the Great Depression, output shrank by 30% and 25% of Americans didn't have work. Have we ignored the lessons of that time?
That's a real danger. I mean, a lot of people are sort of fearing that this may be something like 1937, where the punch bowl was taken away a little bit too soon. We went through this whole rigmarole about the debt ceiling, and we do have a long-term problem with the federal budget deficit. We're on an unsustainable track. It has to be brought under control over the next 10 years. But to act too soon, to start either raising taxes or cutting government spending, that's contractionary, and it's going to weaken the recovery. As it is now, we're looking at fiscal policy to be a major drag in 2012 unless Congress gets its act together and does something to help stimulate the economy.
Scott, we have less than a minute left. As you're no doubt aware, Bloomberg and the Washington Post co-sponsoring that Republican presidential debate tomorrow night at Dartmouth. The candidates, what message do they need to send to the American public? Specifically concerning the economy?
Well, the president always gets the credit or the blame for whatever happens with the economy, and that's a little bit unfair because he's not a dictator. He has to get things through Congress, and even somebody new coming in is not going to be able to get everything that they want. Ideally, I think we're set to have some sort of fundamental tax reform. But just getting there is going to be very, very difficult. So I'd want to hear what the candidates have to say about how they're going to work with Congress and how they're going to achieve a bipartisan consensus. I mean, we hear this all the time, that the two parties have to work together. That's what the American people really want. But how are they going to do that? I think that's what we really need to hear.
Scott Brown, Chief Economist, Raymond James, joining us from St. Petersburg, Florida. Scott, it's always a pleasure to have you on. Thanks so much.
My pleasure.